Hashtag rent versus buy, the ultimate financial analysis. Every single year, millions of people face one of the most consequential financial decisions of their lives. Do you sign a lease and keep renting, or do you take the plunge and buy a home? Financial advisors argue about it. Your parents probably have a strong opinion. And social media is absolutely full of hot takes on both sides. But here is the truth: most people making this decision are working with incomplete information, outdated assumptions, or emotionally charged advice that ignores cold, hard mathematics. Today, we are going to change that. We are breaking down the rent versus buy debate using real numbers, real scenarios, and a framework that will actually help you make the right decision for your specific financial situation. Let us start with a little history, because context matters enormously here. For most of the 20th century, homeownership was considered the undisputed cornerstone of the American financial dream. The government incentivized it through mortgage interest deductions. Banks promoted it aggressively. And for decades, it genuinely worked. Home values appreciated steadily, interest rates were predictable, and the cost of renting versus buying actually made purchasing a reasonable financial move for the average household. Then came 2008. The housing market collapsed. Millions of homeowners found themselves underwater on mortgages, owning properties worth less than what they owed. Suddenly, the narrative shifted. Renting was no longer seen as throwing money away. It became a legitimate strategy for financially savvy people who wanted flexibility and capital preservation. Fast forward to the post-pandemic era, and we now have a market defined by historically unusual mortgage rates that climbed from near zero to over 7%, home prices that appreciated dramatically during 2020 through 2022, and rental markets in major cities that became nearly unaffordable themselves. The question of rent versus buy has never been more complex, or more important, to understand properly. So let us build the full financial picture, starting with the true cost of buying a home. Most people focus exclusively on the monthly mortgage payment, but that number represents only a fraction of what homeownership actually costs. Consider a home purchased at $450,000 with a 20% down payment, which means $90,000 out of pocket at closing. At a 7% interest rate on a 30-year fixed mortgage, your principal and interest payment comes to approximately $2,393 per month. But you are not done yet. You need to add property taxes, which nationally average around 1.1% of home value annually. On a $450,000 home, that is roughly $4,950 per year, or $412 per month. Then comes homeowners insurance, typically running $1,500 to $2,000 annually, adding another $150 per month. Private mortgage insurance is avoided here because of the 20% down payment, but for buyers putting down less, that adds anywhere from $100 to $300 monthly. Then there are maintenance and repair costs. Financial planners commonly use the 1% rule: budget 1% of your home's value annually for upkeep. On a $450,000 home, that is $4,500 per year or $375 per month. Utilities may also be higher in a larger owned home versus a rented apartment. When you add all of this together, the true monthly cost of owning that $450,000 home is closer to $3,330 per month, not the $2,393 figure that headlines the mortgage advertisement. That distinction is absolutely critical to any honest financial comparison. Now let us look at the true cost of renting with equal rigor. Renting gets criticized as throwing money away, and while that phrase oversimplifies reality, it does capture one genuine truth: rent payments build zero equity. In the same market where a $450,000 home exists, a comparable rental might run $2,200 to $2,600 per month depending on the city. Let us use $2,400 as our figure. The renter pays that amount and retains no ownership stake. However, the renter also escapes property taxes, maintenance costs, insurance beyond a small renter's policy, and the massive opportunity cost of a $90,000 down payment sitting locked inside a property. That $90,000 down payment is where things get genuinely interesting. If instead of putting it into a home, that money were invested in a diversified index fund averaging 7% annual returns, after 10 years it grows to approximately $177,000. After 20 years, it reaches roughly $348,000. That is the opportunity cost of homeownership that almost nobody talks about when they are pushing you to buy as fast as possible. Welcome back. Now we are going to do a direct 10-year comparison between buying and renting in our $450,000 scenario, because this is where the real education happens. Over 10 years of renting at $2,400 per month, assuming 3% annual rent increases, total rent paid comes to approximately $329,000. The renter has no property and no equity. However, the renter who invested that $90,000 down payment plus the monthly difference between renting and owning, roughly $930 per month, into the market at 7% returns would accumulate a portfolio worth approximately $410,000 to $430,000 over that same decade. Now examine the buyer over the same 10 years. They paid roughly $3,330 monthly in total housing costs. Their mortgage balance dropped from $360,000 to approximately $309,000 through amortization, meaning they built about $51,000 in equity through principal paydown. If home values appreciated at 3% annually, that $450,000 home is now worth approximately $604,000. Their equity position, home value minus remaining mortgage, is roughly $295,000. Subtract transaction costs of selling, typically 6 to 8% of sale price, and net proceeds land around $247,000. So after 10 years, the disciplined investor-renter has accumulated $410,000 to $430,000 in investable assets. The homeowner has built approximately $247,000 in net accessible equity. On pure numbers in this specific scenario, the renter-investor comes out ahead. But here is where analysis must evolve beyond the spreadsheet. The rent versus buy decision is never purely mathematical, and acknowledging that does not make you financially unsophisticated. It makes you realistic. Several factors consistently tilt the equation toward buying in specific circumstances. The first is the length of time you plan to stay. Transaction costs for buying a home, closing costs, agent commissions, title insurance typically total 8 to 10% of the purchase price. On a $450,000 home, you are spending $36,000 to $45,000 just to enter and exit the transaction. If you plan to stay fewer than 5 years, those costs alone devastate any appreciation gains. Most financial models suggest a minimum 5 to 7 year horizon before buying starts making mathematical sense in most markets. The second factor is local price-to-rent ratios. This is a professional metric that calculates how many years of annual rent it would take to equal the purchase price of a comparable home. A ratio below 15 generally favors buying. Between 15 and 20 suggests neutral territory. Above 20 consistently favors renting from a pure financial standpoint. In cities like San Francisco, Los Angeles, and New York, price-to-rent ratios regularly exceed 30. In markets like Cleveland, Memphis, or Indianapolis, ratios closer to 10 to 13 make buying far more compelling financially. The third factor is leverage and inflation hedging. A mortgage is a fixed debt in nominal dollars. As inflation rises, your mortgage payment stays the same while the underlying asset appreciates and rents around you increase. A homeowner who locked in a $2,393 payment in 2024 still pays $2,393 in 2034, while comparable rents may have climbed to $3,200 or higher. This inflation protection is genuinely valuable and difficult to replicate through renting alone. There are also important tax and wealth-building dimensions to consider. The mortgage interest deduction, while less impactful than before the 2017 Tax Cuts and Jobs Act, still provides meaningful savings for higher-income buyers who itemize deductions. Capital gains exclusion on primary residences up to $250,000 for individuals and $500,000 for married couples means appreciation in your home value can be captured almost entirely tax-free in many scenarios. Compare that to investment portfolio gains, which face capital gains taxes. This tax advantage is one of the strongest arguments in favor of homeownership for long-term wealth building. Forced savings is another psychological and behavioral reality that deserves honest acknowledgement. The rent and invest strategy only works if you actually invest the difference consistently and resist the urge to spend it.